In this tutorial, we'll walk you through automating and understanding the planning for accounts receivable, accounts payable, and inventory, the key components in managing your cash flow projections. First, click the Settings gear icon at the top of your screen. Select the calculations you want to automate and enable the feature by checking the box. Then, map your balance sheet accounts where the calculations will be recorded. Next, input details, such as the percentage of cash sales and the average number of days to collect invoices, pay bills, or turn inventory into sales. For example, we'll assume 0% cash sales and 60-day payment terms for invoices. Once this is set up, map your profit and loss accounts by selecting the relevant income and expense accounts that will influence the balance sheet and cash flow projections. After enabling automated calculations, the rows on your balance sheet related to these calculations will be locked and grayed out. You can override these values if needed to customize them to your preference. Now let's dive into how the automation works. To keep things simple, we'll focus on an accounts receivable example with 60-day payment terms and 0% cash sales. The calculation here takes into account both existing receivables balance and new income from sales. Hover over a cell to view these values. The existing balance refers to unpaid invoices from previous periods. This value is pulled from the last available period, either from the previous year for a budget or the most recent month with actuals for a forecast. As the forecast rolls forward, actual values will replace the old reference data. You can also customize these reference values in advanced settings, so make sure the row drivers are always refreshed to ensure accurate existing balances. With the 60-day payment terms, half of the outstanding invoices are collected each month. So in 2 months, the existing balance will drop to 0 as invoices are fully paid off. The new income represents the current month unpaid invoices, based on your planned monthly sales from the profit and loss. For instance, if you make a $100,000 sale in March, that amount will show on the balance sheet and remain in receivables for 60 days until the invoice is paid. After 2 months, the new income balance will reduce to 0. Under cash flow statement, you'll see a cash inflow of $25,000 in both January and February, coming from existing invoices. Then in March, you'll have a cash outflow of $100,000 to adjust for the new invoices that haven't been paid yet. Once those invoices are paid in May, a $100,000 cash inflow will appear. The process is the same if you have cash sales. The automated calculation would then only include the remaining percentage of sales that are not paid in cash. With Reach Reporting's automation, you can skip complex calculations and simplify your planning process. If you have any questions, send us a chat.